Welcome to the Planet MicroCap Showcase Virtual 2022. I'm your host, Robert Kraft, and now presenting at our event is Nick Blitterswyk. He's the CEO of UGE International. It's a publicly traded company. I got two symbols for you, UGE on the TSX Venture and UGEIF on the OTCQB. And with that, Nick, take it away.
Thanks so much, Robert, and so happy to be here again. And thank you for all your support and the great work you guys are doing over time. So I look forward to running through the latest and greatest deck for UGE here today. Just a quick, typical disclosure statement at the top there. So for those of you who aren't familiar with UGE, we are a solar developer. So we develop primarily community solar projects and primarily across the US. So we go out there, we find places to develop these projects, we bring them all the way through, and we're building up a portfolio of long-term assets that will generate revenue for us for the decades to come. We have right now about 412 megawatts of projects in development. We'll come back to like how those projects are valued a little bit later, but roughly speaking, that's around $1 billion or more of gross project value that we're developing there right now. We focus on the community solar space. That's a fast growing part of the overall US solar industry, which many of you will know as a whole is also growing very quickly. So we very much feel like we're in the right place, right time for the part of the industry that we're in. The company started about 13 years ago. I'm the original founder of the company. As we've grown and evolved and gained experience in the industry, we've developed what we call a full life cycle approach to what we do. So we, like I was saying, we go through right from that first interaction with a client or landowner where we're going to develop a project, all the way through to operating an operational project as well. And we really feel like in this mid-scale solar space that we're in, that maximizes both the margins and profits that we're able to get from our projects, the experience we're able to provide to the landowners and companies that we work with, et cetera. So we're really excited about how we stand out based on that full life cycle approach. And then lastly is that within this space, we're one of the most experienced companies. We've been executing on community commercial solar projects for well over a decade. Most recently, T-Mobile and Bloomberg are two of the clients that we've worked with, but over the years, we've worked with a number of other big names as well. I won't go into too much in terms of the background of the company, but suffice it to say, we've always been innovating and building our company around this mid-scale solar/renewable energy space, and have a long track record of doing some really interesting projects, and really hit our stride here right around I would say the beginning of 2020. And this decade so far for us has been by far the highest growth time for the company, and we're really excited about just how much we're going to grow this decade. Now, some people listening probably are solar experts. Some people are more novices in that area. I'll just say, like, the background to all of this is that solar costs have come down and down and down over time. Yes, it's not a perfectly straight line, but solar is the cheapest form of energy in more and more places. The International Energy Association predicts that by 2030, solar will be 80% of all the new energy capacity being built each year. In 2022, this will be the first year that it's above 50%, we expect, after being in the 40s in the last 3 years. So it's a really exciting time. And if you think about the overall pie, especially as like the electrification of transportation and so on and so forth, the overall pie heavily dominated by solar going forward, and we're really confident that that's the place to be. So on the community solar side of things, whether you're thinking about commercial and you're thinking about solar on the rooftop of a big box store or something like that, or if you're thinking about like, residential and people putting solar on their houses, etc. I think the thing to keep in mind is that in the neighborhood of 80% of all houses can't put solar on their own house because they're renting, because they're in a condo, because they have shading issues, whatever the case may be. For businesses, that's over 90% because they're in office buildings. So they're also renters or whatever the case may be. So that's like a massive part of the overall energy usage, right? That's who uses energy for the most part, homes and businesses that can't put solar on their houses themselves. So what community solar is, we install like centralized systems, and then we sell the energy credits that we're generating to the subscribers, which can be those homeowners or households more generally, small businesses, large businesses, etc. And so, based on like the large size of that potential cohort, this industry is growing incredibly quickly. Regulations have been opening up to allow that type of construct where we can put a project in one place and then remotely sell the credits that are being generated by that system, fed into the grid, but then the credits are bought by the subscribers to those systems. The Department of Energy is very firmly behind the growth of community solar. It often benefits, you can imagine, low and moderate income communities that can afford to put solar on their house or live in an apartment or what have you, as well as like small businesses who similarly can't, don't own their own buildings or whatever the case may be. So the Department of Energy is firmly behind this. A goal to grow at 8x in just 4 years. The Biden-Harris administration came out and reiterated that same goal earlier this year. And so really excited for just how much this space is growing. There were 22 states in 2021 alone which passed regulations allowing for community solar. So we're seeing like this map get colored in really quickly here. We were the first ones in New York in 2017 to develop a community solar project. We think the first ones in Maine in 2019 as well. So we've really been at the forefront of a number of these states. Right now, we're at the forefront of states like Pennsylvania, Maryland, Virginia, California, Oregon, and just continuing to build out our portfolio of projects that we're developing here. And I talked about us being a full lifecycle developer earlier on, and what that means is, we are really owning that whole process. And this can be a 3-year process from the time that we're originating a project, working it through all the development stages, the biggest of which is getting interconnection approval and negotiating interconnection upgrades with the utility, getting that project engineered, built, financed, and then owning and operating the asset long term. We're in a space that's still quite fragmented. There's developers who develop, and actually there's also originators who just originate projects. There's companies who just engineer or build them. There's funds who just own them. So us being able to bring together that full life cycle has really allowed us to scale up, capture more market share, and based on the profile of our projects, we really feel like this is going to provide us with a really strong profitability advantage over time as well. So in terms of the benefits of our approach, so equity light, you might be surprised to hear us say equity light, but the reason for this is because as we finance these projects, there's an investment tax credit. I'll come back to this a little bit later because it was enhanced quite a bit by the Inflation Reduction Act recently, but there's the investment tax credit, which provides a good portion of the capital stack. And then there's also a number of banks that we work with that provide leverage to our projects as well. And we also have been quite active on a secured green bond product as well. What that means is that as we're developing these projects, we fully fund the capex of them. So from an equity perspective, it'll be quite cash flow positive as the portfolio scales. But like we don't need to be in the market raising equity to fund our projects because the magnitude to which we can get the tax credit and project leverage is greater than the actual capex for the project. I've mentioned this a couple times, but just in terms of the efficient delivery on our rooftop side of things, on like industrial rooftops, we work with a lot of like REITs and large real estate owners where we're working with them time and time again. And the reason I mention that here is because we make their life a lot easier by just being the one company that they're going to be working with that entire time, as opposed to all the handoffs that are pretty common in our industry. And then lastly, when we're developing these projects, we aim to have 40 years of recurring revenue coming off these projects. Typically, it's anywhere from 25 to 40 with a more heavily weighted towards 40. So, we have a very long-term revenue profile as these projects come online. And so, even if you think about like the renewable IPPs out there, some of the larger ones, their average lifetime is often less than 15 years. So for us to have such a long recurring revenue stream out in front of us, we really expect that that'll open up a lot of avenues for us in terms of dividends as the portfolio grows, and also just getting lower and lower costs of capital as the risk profile of the company decreases as that portfolio grows. We've been scaling up incredibly quickly here the last 2 to 3 years. This is a snapshot of the overall pipeline of what we're developing here. Now, I'll say that on a per megawatt basis, the value of those megawatts and like a gross project value, roughly speaking, is like north of 2.5 million per megawatt, sometimes north of 3 million per megawatt. So you can do that math yourselves to understand just how big this portfolio is. But you can see like the pipeline over 1.3 gigawatts in development is around the 400 megawatt mark. Within that, there's currently about 240 megawatts of backlog. Our operating portfolio is just scaling up. We turned on our largest project so far a couple of months back, and we're in the process of starting construction on about 20 megawatts of projects. So we'll see that operating portfolio scaling up really quickly in 2023 and beyond as well. We've, as we've been growing so quickly, we've also been exceeding expectations. In 2021, we had a goal to get to 120 megawatts of backlog. We ended up getting north of 150. This year, we set a goal to get to 250, and based on the small size of that bar above target adds there on the right, we're expecting to be able to surpass that goal as well. In total, that's about 15 times growth since the last couple of years. And our team is as hungry as ever, and I think the market conditions are better than ever, especially in the wake of the Inflation Reduction Act. I won't spend too much time here except to say two quick things. That full life cycle approach means we're capturing value across the different stages. And then in terms of how that value trickles down, which is really like the difference between the fair market value of a project we're creating minus the cost to create that project. This is a New York example that comes out at 81 cents per watt. So on a typical, say, 2 megawatt project, that's a delta of 1.6 million, give or take, that we would be creating on just that one project. But it gives you a sense in terms of that net value that we're creating there. In this forum, I'll say I won't spend too much time on these project examples. The deck is available on our website, so feel free to take a look there. Come back to us with any more detailed questions. But just at a high level, again, UGE is the quarterback that's bringing this all together. We're lining up the subscribers who buy the energy from us, the place that we're going to develop the project, getting that project built, financing it, owning and operating it. The right-hand side really comes down to this equity light aspect that I've been mentioning. If you look closely, the uses on the right versus the sources on the left, we have like a delta of additional capital that comes back to UGE. That's really visible in the bottom left graph, that blue bar with 523 above it. So as we develop this project, we expect in this example, to capture about $500,000 of cash back up front, and then also the cash flow from the project over time. And then on an IRR perspective, this one has an unlevered after-tax IRR of about 15%, which is about in the middle for us, maybe a little bit above the middle. But typically we're earning unlevered after-tax IRRs in the low to mid-teens type of range from the development work here that we're doing. There's a New York example too. For the sake of time, I'll just skip past it, but it's available on our website. So far we've been talking just about solar. I will say that on the energy storage side of things, it's a very similar cost curve that's been happening. So energy storage has been getting more and more exciting as well. Complements solar obviously very, very well. We about a year ago entered Massachusetts, the storage market there. We have a really good pipeline and backlog of projects in the Massachusetts storage market, and we're looking to use that same experience to develop these types of projects in other markets as well, and expect this to be an increasingly important part of our development work over time, whether coupled with solar or in some cases on a standalone basis too. You can see those revenue drivers in the bottom right, which are of course for competitive reasons meant to be generic. But there's like these different ways you can earn revenue from these storage projects, shifting load from high demand times to low demand times or vice versa. Offsetting peak hours, frequency regulation. There's these types of things which drive the revenue profile for these projects. What it boils down to on a per megawatt basis, pretty similar economics to our average solar project. So going forward from here, we've been building up our operating portfolio. It's still small compared to our goals, but we expect to get to 100 megawatts of operating assets by the end of 2024. But we have a 500 megawatt goal 5 to 7 years from now. So 100 megawatts for us, we really think about it as base camp. As we saw earlier, we have close to 400 megawatts of projects in development. So we feel like we're in a really good spot here to meet or exceed that goal, but also to be well on our way towards our medium-term targets there as well. And along the way, looking to add 100 megawatts per year of projects as well. And this year and last, we will have added about 100 megawatts of backlog. So we're already working at a pretty similar rate there. Um, on 100 megawatts of projects. So earlier there was that 81 cent per watt mark. That comes out at about 80 million US of net value from 100 megawatts. I think more than twice our current market cap. So I think there, it speaks to the upside there. But then also on 100 megawatts, the revenue profile tends to be a bit north of 20 million US per 100 megawatts. And if you look at our financials, we've tended to average gross margins in the 80s. Our last quarter was actually in the 90s, but it's a very high gross margin profile that we're generating here. On the market side of things, Robert mentioned off the top, we're traded in the TSX-V. Current market cap in Canadian dollars in the 50s. I think in US that puts it in high 30s or 40 type of mark. Clean balance sheet. At the operating level, we have very minimal debt. The debt that's shown here actually includes, in essence, like project debt, primarily the green bonds that I mentioned earlier. But also, only 33 million shares outstanding, insider ownership of around 33%, and pretty limited warrants and things like that as well. We haven't done an equity deal in pretty close to 2 years at this point, and feel we have a pretty clean structure out there. There's 4 analysts that cover us, 4.5. I'll touch on the half in a second, but appreciative of all the support there. The average target price here is about 2.33 times where we're trading right now. I'm sure all these analysts would be more than happy to hear from you and share their work. 8 Capital also covers us, but they're just going through a change in terms of their analyst, and so they're not currently listed on here. We announced our Q3s last week. All that information is available on our website and on SEDAR. What we're seeing though is the operating portfolio, it doubled in 2022. It's going to do more than that in 2023. But as that grows, we're seeing, you can see the energy production here growing almost 10x in the last couple of years, and we're going to see that really scaling up here quickly as well. And we've also done a really good job of minimizing dilution as we scale up the portfolio here. Now, to a degree, it goes without saying as a solar company that we have a high ESG aspect to the company, but we do publish an annual ESG report, and you can get the fundamentals here. The report itself is available on our website, or feel free to reach out to us to get a copy. And then just a few different recent updates. We organically touched on a lot of this as we went through the deck. What I'll touch on briefly, though, is on the Inflation Reduction Act side of things. We were really excited for how that came together in August of this year. The baseline, the U.S. solar industry has really been supported by the investment tax credit over time. It was originally implemented, I think, 16 years ago by President Bush at that time. What this does is it extends it for another 10 years, but also adds a whole bunch of different ways that it increases value. Like, for example, using domestic content gets you an extra 10%. Locating a project in certain areas also does similar, it gets you another 10, 20, or 30%. So I think our average investment tax credit over the next decade is going to be well north of 30%, which just further speaks to the value that we can create in this industry, but also excited to put our heads down and be able to just really focus on the business here for the next decade. And then just 2 more slides. One is on the green bond. Just last week, we closed our biggest one yet. That came in at about 7.4 million Canadian, but this is secured by portfolios of our projects. We actually issued 3 of these throughout the year as our portfolio continues to grow, and look forward to being able to continue to grow this product next year as well. And so just bringing it all together, so number one is we are very experienced in this space. We have a very, very strong sense of what we're doing. We've built out the team a lot over the last couple of years, adding additional expertise and talent to the areas of the company where we've been growing the fastest. community solar is the fastest growing part of the US solar industry. So we very much feel like that expertise is here at the right time to take advantage of this opportunity. We have a great backlog and pipeline that we feel is one of the best in the industry. And the full life cycle approach is really allowing us to maximize the value that we get out of that. So it all comes together for us to be very well positioned for growth here in the years to come. So with that, Robert, back to you.
All right, Nick. Well, thank you so much for your presentation here. Really do appreciate it. You addressed my first question when I was talking about the Inflation Reduction Act. You mentioned it in, I think it was not this slide, but 2 slides before. So thank you. Maybe expound on that even a little bit more, because I think one of the analysts that covered you, Cormark, did a whole webinar about that and how UGE may or may not benefit from it. So tell us a little bit more and what that means maybe going into 2023.
Yeah, there's a number of layers of the onion to peel back, and they're all positive here. So the first one is the investment tax credit, and in essence, that says, hey, if you're creating a project that's worth, say, $1 million, the 30% tax credit gives you $300,000 back. And so putting that in place for 10 years is a great long-term part of the business to build around. But then what the IRA did also is it created these adders. Say, hey, we want solar developers to benefit energy communities, places that have had a lot of exposure to coal mining, things like that, or low and moderate income communities, or capped landfills, and these types of things. There's a lot of opportunities for you to increase that investment tax credit that you can get. The ITC is now also, you can apply it to things like standalone energy storage projects, upgrades to when you connect a project, you often have to pay for upgrades to the grid as part of the bargain there. Now the ITC is applicable on that. So there's all those types of good things. But then in addition, for the industry as a whole, there's all these tax credits to boost manufacturing in the US. We're not a manufacturer, but what you're already seeing is just announcement after announcement from manufacturers who are increasing supply here. And I saw a Bank of America research note that was saying, like, hey, right now the cost to build panels are in the range of 25 cents per watt. We pay right now probably closer to 40 cents a watt when you factor everything in. The IRA has about a 17 cents per watt benefit to manufacturers. So if you're a manufacturer, you can get like 17 cents of that 25 back in the form of a tax credit. So what that's going to do is it's going to boost supply, shorten lead times, and I also think really drive down the costs of our inputs too. So I could go on and on, but I think those are like the main headlines there.
Absolutely. So Nick, my final question for you here today, and look, I've known you a long time. We've done a number of interviews over the years. I've seen you progress to where you're currently at today. As the company exists today and looking ahead at 2023, what would you say is the biggest inflection point that you're hoping to see that will then really result in some of the growth that, I think, you and some of your stakeholders are hoping to see as well?
Yeah, I would say it this way. The inflection point in our mind really happened around like late 2020. So we feel like in that hockey stick, we already like well up the growth curve here, and we've seen that with just how fast the portfolio is growing. I think that the market, I think, will catch on to that value that we're growing. Like again, market cap of, if I use US because our projects are in the US, market cap of sub 40 million USD. We're developing well over $1 billion worth of projects right now. And like in our industry, you can take those projects and you can sell them well before you even construct them. Like I feel very confident that there's value in our backlog and pipeline right now, well in excess of where our market cap is. But to kind of come back to the question you were saying, I think that the market will really, I hope, start to take notice as more and more of those projects come online. We know that there's value as they exist today, but I think a large portion of the market is waiting to see that demonstrated a bit more in terms of the cash flow coming off an operational portfolio. And the good thing is that's about to happen. We have 2.8 megawatts operating right now, about 20 megawatts that are just in the kind of earliest stages of being deployed. And so we look forward to demonstrating that in the quarters to come here.
Absolutely. And real quick, final question for you. I know I said that was the final question. I got one more final question. And this is one I'm asking everybody who's presenting here at our conference today. So we're managing through tough markets. What measures is the company taking to manage some of these macroeconomic pressures that are affecting most microcap companies across the board?
Yeah, I think on the market itself, managing dilution, just not going to the market in a time where it's not favorable, and continuing to communicate what our goals are for the business and how we're meeting those KPIs towards our goals, and in doing so, we really hope continuing to build up confidence in the growth strategy here, and I think to the degree there was like an even more macroeconomic question there, and I would just say like the overall space that we're in with supply chains and interest rates and everything else, I think we're in a business that has a very natural hedge to that in the sense of like inflation's driving up the revenue we get from our projects, even more so than the inputs to our projects. And so, feel like we're pretty well set up in that regard as well.
Very good. Well, Nick, we're there. Thank you so much for your presentation here today. To everybody watching, thank you for participating and have a great rest of your event. Thank you, Nick.
Thanks so much, Robert. Take care.
Thank you.